Hi folks, my name is Brian Emmons and this is my colleague Eva Walker. We are with Southern Land Company at the Laurel. We'd like to thank everybody for joining us today. We're blessed to have Kevin Gillen with us. We're going to get with Kevin here in 1 second. We're going to take a few minutes to let everybody log on. Today we're going to be talking about the state of the real estate market, but before we do that, we just want to take a couple seconds and update you on the Laurel. As everybody knows, the Laurel is the last high-rise to be built on Rittenhouse Square at 1911 Walnut Street. Construction started a little over a year ago, and we're currently on the 9th floor. For all those neighbors that are watching, we know some of those concrete trucks have been a nuisance in the last couple of weeks, and we apologize for that. But we're doing everything we can to get the building constructed as fast as we can. Right now, we're projected for completion for middle to third quarter of 2022, and we're pretty excited to get things going. So with that being said, I would just want to talk about one interesting thing. You know, every single week, even the sales team gets lots of questions from our prospective buyers and our buyers, like what's happening with the real estate market. It's a question that we get 2 or 3 times a week. And instead of the Laurel team giving you our opinion, we thought it would be great to bring in the region's best economist, Kevin Gillen, to actually give you the facts. So with that being said, I'd like to introduce you to Kevin Gillen. Kevin is an economist who holds positions as a senior research fellow with the Lindy Institute for Urban Innovation at Drexel University, and is a senior economic advisor to Hauser LLC. With a background in urban economics, real estate finance, and public policy, Dr. Gillen's research and consulting practice is concentrated in applied work in the analysis of real estate developments and operation of real estate markets, including their fiscal, economic, and financial implications. This work is deployed in advising both public and private sector entities in the cost benefits of public policy options, as well as the design implementation of local economic development strategies. With research on urban economic issues appearing in numerous publications, and he is cited in various policy applications. With that, Kevin, thank you for joining us today.
Thank you for having me, Brian. It's a pleasure to be here. So, Philadelphia's post-pandemic housing market, where are we and where are we headed? Good morning to everyone, and thank you for Brian and Southern Land for having me. We'll start with, of course, where our housing market is, and then I'll talk next about where it's going and where we think it will end up. The short answer is, well, all things considered, our markets and our housing economy here, especially here in Philadelphia, is doing much better than you might think, especially if you asked me this, 8, 9, or 10 months ago. So this is my house price index for Philadelphia, the red line that you see on the chart before you. Basically, you can think of it as a Dow Jones index, but for the value of the typical Philadelphia home. So the actual level of the index doesn't mean anything, but its percent change over time reflects the typical appreciation rate or depreciation rate in the value of the typical Philadelphia home. So the index has a starting value of 100 way back in 1980. And you can see the big rise during the 1980s, the decline during the early 90s, and of course the housing bubble years of the mid-2000s. We hit a peak back in about 2007. From peak to trough, the index fell about 23%, which indicates that the typical Philadelphia home declined in value by approximately 23% during that period. Then you see the rebound, the current expansionary cycle, which began back in 2012. Since house prices began recovering 8 years ago, the general level of house prices in the city has risen 57% since 2012. And right now, house prices in the city are about 28% higher than their previous peak back in 2008 at the peak of the previous cycle. And by the way, this index is through Q3. So this index is only a month old. So it's pretty timely. The next chart shows the median house price in Philadelphia, again, during the same time period, going back to 1980. That's represented by the blue line. Again, the red line is my house price index. As you can see, the blue line is a lot more volatile than the red line. That's because raw house prices or raw condo prices have a lot more seasonal noise in them and idiosyncratic noise, especially over short-term periods. So the regression that I use to compute the house price index washes out all that noise. But I show you this chart because this past quarter, the city passed another milestone in terms of its house prices, and the median house price in Philadelphia crossed $200,000 for the first time in history just a few months ago. The last time it crossed such a significant threshold was way back in about 2006, when the city's median house price crossed $100,000. So For the first time in history, the median house price in the city in Philadelphia is just over $200,000. So not only is the city doing very well compared to its own history, it's actually doing very well compared to its own suburbs. So I also produced a regional report that has a suburban house price index for the entire region. It covers Southeast Pennsylvania, South Jersey, and Northern Delaware. And the green line in this chart is the suburban house price index for the greater Philadelphia metro area. It includes all those counties, all the counties in the states I just mentioned, except Philadelphia County. And then the blue line is the house price index for the typical U.S. home that's computed by the federal government. So you look at it historically, the red line has basically been chasing the green line for decades, indicating that the typical Philadelphia home is not only priced less than the typical Philadelphia suburban home, it's actually appreciated at a slower rate over time. It's offered a lower rate of return. Roughly from peak to trough during the last downturn, house prices in the city and the suburbs fell by approximately the same amount, about 23%. But look at the difference in the recovery during the current expansionary cycle. Not only has the city recovered and erased all of the housing wealth that was destroyed during the Great Recession, it's well above its previous peak, but it's also now well above where the suburban level of house prices are. In other words, the typical Philadelphia home has offered a much better rate of return than the typical Philadelphia suburban home during the current expansionary cycle. In fact, the general level of house prices in the suburbs is still below its previous peak back in 2008. That's primarily driven by South Jersey, which is really dragging down the rest of the market. Different story for Southeast PA. But still, on average, the typical Philadelphia home has outpaced the typical suburban home over the last 8 years in terms of its price appreciation. The city has especially outperformed the suburbs since COVID hit. This shows the year-on-year change. This shows the house prices by county across the region. Again, the red line is Philadelphia. The green line is the suburban county. The other lines are the suburban counties. The blue lines are the Southeast PA counties. The green lines are the South Jersey counties, and the purple line is Newcastle County, Delaware. So if you think of this as running a horse race between the value of a typical home in each of the 11 counties in the region, you see which one comes out on top. It's the red line. It's Philadelphia. By the way, you notice that it's even outpaced Bucks County and Chester County, which typically lead the race historically, and it passed them only in the last 6 months. And we have the rates of return that have varied by county. So if you want some hard numbers comparing how Philadelphia has done to the suburbs, this shows the percent change in the general level of house prices by county over different time periods. So if you look at the Philadelphia County is the one all the way to the left there. So if you look at the row that says 10-year, that shows the average 10-year change in house prices for each of the counties. So looking across that second row, you see the typical Philadelphia home is appreciated by about 44% over the last 10 years. And if you look at the suburban counties, you see there'll be much smaller numbers. Particularly the South Jersey counties are still in negative territory compared to where they were during the last housing bubble. Just over the last year alone, the typical Philadelphia home has offered a rate on return of 8.4%. All right, that's the if you just bought a random Philly home 1 year ago and sat on it, you could expect a rate of return of 8.4%. Look at the surrounding counties. Again, they're all in the low single digits. None of them come even close to 8%. Now, during the last quarter, the suburban homes have really started to catch up. You'll see some significant rates of appreciation over the last 3 months, but that is a very recent development. Next, I'm going to show you a map of the city, and the definition of center city continues to expand. So this is a map of the most recent quarter home sales in Philadelphia County. Each dot represents a home transaction in the city, and I color code them by the price per square foot. So the cool colors denote relatively low price transactions, and the warm colors denote relatively high price transactions. So the red dots are the top 20% highest price home sales, and they transacted at a price point of $240 a square foot or more. The blue dots are the 20% of lowest price home sales in the city, and they transacted at a price point of $75 a square foot or less. So if you look at the very center of the map, you can see Center City. That's the cluster of red dots around there. What is the market considers the geographic definition is very different than what most people would consider the traditional geographic definition of Center City. In particular, you'll see how those red dots have just been spilling out into the surrounding and adjacent neighborhoods of Center City as the location value of Center City has risen over time, but the cost of living there has also risen. So a lot of the demand that would otherwise be in Center City or could afford Center City 10, 20 years ago is spilling out into the adjacent neighborhoods. You see, Fairmount, Brewery Town, Fishtown, the Port Richmond, Northern Liberties, Queen Village, Graduate Hospital, and those areas right now are priced what a typical Center City property would have been priced at 10, 15, even 20 years ago. So I also produced a condo report for Philadelphia, and the purple line here represents the condo price index for Philadelphia. In general, condo prices in the city have been somewhat cooler than house prices during the recent expansionary cycle. Historically, they tend to somewhat outperform house prices. That is, when the general housing market is up, condo prices tend to be up by more than house prices. Condo prices fell by less than house prices during the Great Recession, but the recovery has been somewhat less. Now, that's a citywide number. It breaks down very, very significantly by neighborhood when you look at condo prices compared to Center City, adjacent to Center City, and then, of course, the outer neighborhoods. And the next slide will show you that. So I then break my condo price index into three components based upon core Center City, adjacent Center City, and then what I'll call the outer neighborhoods, which is basically the rest of Philadelphia. The red line in the purple line in the middle is the average condo price index for Philadelphia. The green line at the very top represents core Center City. The brown line represents adjacent Center City, and then the blue line at the bottom represents the outer neighborhoods. And as you can see, condo prices in core Center City not only held their value much better than the rest of Philadelphia, but also the rest of condo values in Philadelphia, and have since recovered at a more significant rate than condo prices in the rest of the city. So that's where real estate prices are. Next, I'll talk about actual transactions volume. So the next slide here shows house sales for Philadelphia County over time. Again, this goes back to 1980, just like my house price index. The red line represents the average number of transactions each quarter in Philadelphia. So you can see that home sales are very, very cyclical, just much like house prices are. And if you want to see how the pandemic hit us, it hit us this year. It hit us very hard. In just 3 months, from winter to spring of this past year, we saw a 41% plunge in total home transactions in Philadelphia. All right, 41% drop in home sales activity. That made this past spring the worst spring since 2012, when the market was still in its previous downturn. But then, of course, we've had the quarantine lifted. Real estate transactions have risen and showings have been allowed. We've had a 71% increase this past summer through the end of September. So a real rebound in home sales activity since basically the quarantine has been relaxed and real estate became, declassified as a non-essential activity. Right now, even during these challenging times, you can see the current blue line is above that red bar, which indicates that sales activity in Philadelphia is still running well above average, despite the headwinds that it's had to face here in 2020. So this shows home sales for the entire Philadelphia metro area. This goes only back to 2005 because I don't have complete home sales in the region going back further than that. Home sales in the region actually only took a slight hit during the spring, whereas the city took a much bigger hit. But home sales activity in the region has rebounded significantly as well. If you look at the blue bar all the way to the right, you'll see that home sales activity in the entire metro area set an all-time high this past summer, in terms of the number of homes that we had changing hands. So again, the suburbs didn't take quite as big a hit as the city, but they rebounded just as significantly as the city has. So just zooming in on the most recent quarter, the region, primarily driven by the suburbs, only had a 6% drop in sales this past spring, but again, a 64% increase this past summer. Right now, this past summer alone in Q3, we had nearly 27,000 homes change hands in the greater Philadelphia metro area, an all-time record. All right, so home sales activity, the city and the suburbs are now running at an all-time record value. Next, we'll take a look at condos. Now, condo sales did take a hit in Q2, but believe it or not, they actually fell by less than home sales activity in Q2. They only took a 26% decline in 3 months compared to a 41% decline in house sales. They've also rebounded since then. I don't have the number for Q3 yet because I'm still working on that, but in general, they have rebounded. But condo sales tend to show less fluctuation from quarter to quarter because they're not driven as much by seasonality as home sales are. The segment that's done the best of all in terms of sales volume is actually $1 million home sales. So this is a chart that you guys are the first ones to see. It's part of my regional report, which will be released either tomorrow or Monday. But you're the first to see it besides me. This shows the total number of $1 million home sales in the region going back to 2005. Look at that huge spike all the way to the right. That's just from this past quarter in Q3, July, August, September. Historically, you see the red line represents the average number of $1 million home sales in any given quarter. We had nearly more than double our typical volume of $1 million sales in Philadelphia and the suburbs this past quarter, an all-time record in terms of the number of $1 million home sales. And of course, you probably want to know where they are. So this is a map showing where the $1 million house sales are in the metro area. Those are the red dots represented on the map. You can see where they cluster. There's basically, 3 big clusters. You've got Center City, Philadelphia. You've got the main line, and then you've got Princeton, New Jersey up there in the upper right-hand corner. You'll see a scattering of $1 million sales in, central and northern Montgomery and Bucks County and parts of Chester County. But you see where the real concentration of the $1 million sales are. And if we drill down to just the city, of course, you can see where the big money is hitting on the map. And you can see the concentration of those red dots. That's, again, just from just this past summer, $1 million transactions in Philadelphia. You can see how they're clustered overwhelmingly in and around Center City. All right. So that is where our housing economy is at. And of course, now you probably want to know where it's headed. Well, the short answer is it depends on what indicator you look at. So I'm going to show you some of my favorite leading indicators and tell you what I think they mean for the short to intermediate future here. So not only is transactions volume very high, but the pace of transactions is very hot right now. So this shows the average days on market for a typical home in Philadelphia. Days on market being just the number of days it takes for a typical home to sell once it's listed. In a balanced market, you typically have somewhere between 40 to 60 days as the average time it takes to sell a home. Again, that's in a balanced market. It's neither hot nor cold. You can see how days on market really rose during the housing bubble years as the housing market started to cool down. Days on market, the time it took to sell a home started to rise before house prices actually declined because house prices were just overpriced relative to their fundamentals, so they took a longer time to sell. You see the decline in average days on market since 2012 as the market has recovered. And right now, the average days on market in Philadelphia at the time it takes to sell a home is actually is just over 30 days, 34 days. It's near an all-time low. The last time it was that low, again, was during the red hot days of the housing bubble way back in about 2004, 2005. So not only is the total transactions volume of homes in the city at an all-time high, the time it takes to move those homes is at an all-time low. Building permits in Philadelphia have been holding steady, so the builders are still behaving as if they're relatively bullish on the market. This shows the number of residential building permits in Philadelphia going back to 1990. Again, you can see the green component represents the green component represents multifamily homes. The purple represents single-family homes. The number of building permits that were approved in Philadelphia so far this year, this is an annualized number, is 3,200 units. So right now we're on track for 3,200 units to be approved, new housing units to be approved and added to our housing stock. That is below what it was last year, but considering that what we had to face this year in terms of the pandemic and the social unrest, builders are still remaining pretty bullish on Philadelphia. They are committed to being here, and they believe that people will still want to live here and even move here, and so they're still adding to our housing stock. Now, this is one reason that I think we've seen such significant increases in house prices recently, is that inventories in Philadelphia, as well as nationally, remain very low. Inventories are simply the number of homes listed for sale in any given period in the city. That's represented by the red bars. The blue line represents the percent of homes in each month that actually sold. So again, inventories tend to be a very good leading indicator of the market. You can see how they really started to swell really fast back in 2005, 2006, before the actual housing market peaked in 2008 and prices began to decline. And again, inventories began to decline in advance of house prices. So when inventories are going down, house prices start to go up. And you can see right now, inventories are near an all-time historic low in Philadelphia. And because supply is so restricted during a period of when there's been relatively high demand, I think that's one reason we've seen, such positive appreciation in Philadelphia and indeed in many cities around the country. Right now, Philadelphia's housing market would be characterized as being in a very deep seller's market. This chart shows the month supply of inventory in Philadelphia. It's basically the number of days it would take to burn off the current inventory of homes listed for sale if no one else listed a home for sale. So in other words, if all the homes that were out there listed for sale continued to transact at their current pace and no one else listed a home for sale, we would burn through our current month supply of homes in 2.1 months. Right? There's only a 2.1 month supply of homes listed for sale. To give you some context for what that number means, in a balanced market, you typically have between a 5 and 7 month supply of sales. That's indicated by the area between those two dashed black lines. And right now, as you can see, month supply of inventory is not only low, it's at an all-time historic low. So demand is up at a time when supply is exceptionally low. And of course, Econ 101 means that, puts upward pressure on house prices. One bearish indicator that we have out there that I'm watching very closely on the next slide is mortgage delinquencies. We've had a moratorium on both evictions and foreclosures here in the Commonwealth, as well as many other states. Delinquencies tend to be a leading indicator of foreclosures because, of course, you go delinquent on your mortgage before it gets foreclosed upon typically. So that's a number I watch very closely. And you can see the big spike, the big spike in delinquencies when the housing bubble began to burst, 10 some years ago. And you can see the spike in current delinquencies. Now, I want to point out this is a national number. This is not a Philadelphia number. We have not seen a big spike in foreclosures, in Philadelphia yet. But this is, a national indicator that also has local implications. So it is something that I'm definitely keeping my eye on. All right, so that's where the indicators are pointing towards where we're going. So I showed you some numbers where we are. I've showed you some numbers indicate where we might be going. Things still look pretty bullish. The last thing I want to conclude is, despite all these challenging and uncertain times, why is housing done so well? Well, the short answer for that is there's actually several reasons, and I'll step through them and then wrap up here. So what are the reasons for optimism here and bullishness? Well, first of all, home sales have rebounded significantly once real estate became reclassified as an essential business, which it was not during this past spring during the quarantine. So when there were no showings this past spring, no homes were really transacting. Once that quarantine was lifted and real estate was able to transact again, showings were able to be done, and the other businesses associated with real estate were, classified as, again, as not being non-essential. I'm thinking of appraisers and things like that. That released a lot of pent-up demand, which really showed up in June. We saw low levels of home sales in the spring, but once that quarantine was lifted, that pent-up demand was released, and it's still going. Number two, the shift in work, especially traditional office work, from offices to home, has provided a lot of support to the housing market because basically it's effectively upzoned a lot of single-family residential homes, basically to commercial mixed-use homes. And so that's provided a lot of support for the housing market by increasing not only the demand for housing, but the essentialness of housing to the current economy and how we operate. Third, we've also had some, as I pointed out, very low levels of inventories, which have put a lot of upward pressure on house prices. And then lastly, I'll talk about, I think, how cities have actually been much more resilient to challenging times than I think many people right now in this day and age are giving them credit to. So if I talk about the shift in work from office to home, this is a big one. Basically what the economy did, when we reverted to doing business by Zoom meeting like we're doing now, is that it shifted a significant percentage of the labor force from what were traditional offices to our homes. And then, like I said, that essentially upzoned millions of houses in the U.S. housing stock from single-family residential to commercial mixed use, which shifted not only demand for real estate from commercial to residential, but also made the demand for residential space more inelastic. That is, meaning it's more essential to the economy. I'll give you some quotes supporting that. This is from the principal of a major California brokerage firm, shared this with me recently at a conference. As a result of the quarantine and the shift towards working from home, housing has become the new toilet paper. It's completely essential and in huge demand. A senior officer with the National Association of Realtors told me, the home is no longer just a residence and an office. It's now become a gym, a school, a restaurant, a spa, a library, an escape, and a theater. And if you have any outdoor space, that's now also a private park. So all the money in the economy that otherwise would have been spent outside the home on all those things is now spent within the home and on the home. And that's resulted in a massive shift in spending from dining, traveling, and entertainment to residential investment. And that is huge news for our industry, huge news for our industry. Lastly, another senior officer with the National Association of Realtors told me, in a post-pandemic world, the home is no longer the focal point of living. It's become the focal point of the entire national economy. It's become the focal point of the entire national economy. So pandemic, maybe not good, certainly not good for us personally, maybe not good in general for the overall economy, but it's been very good for housing. Thirdly, there's been a great technological leap forward in how housing is bought and sold. Basically, the quarantine has forced brokers to move from the physical world to the digital world. This was in response to the quarantine. And there's a lot of both important and positive consequences to this. For example, everything now on housing is now done virtually and digitally. Showings are done online. Mortgage applications, approvals are done electronically rather than in person. Valuations are done by automated models, computer models, rather than in-person appraisals. E-signatures, DocuSigns by closing are done also online. That's become the new normal. The principal of a local brokerage here in Philadelphia told me, the pandemic forced the real estate industry to accelerate the adoption of digital technology by 5 years faster than it would have otherwise, 5 years faster. And as a consequence of that, if we go to the next slide, that's resulted in a major productivity gain for the real estate sector, which is the biggest industry in the U.S. Economy, because there's now a substantial reduction in time, and hence there's less wasted time, and not just for realtors and other industry professionals like appraisers and lenders, but also for sellers and buyers when involved in the typical transaction of a home. To give you an example that a broker in Boston described to me, one of his clients was a very high-powered lawyer for which he served as the lawyer's agent. And being a lawyer, he thinks in terms of billable hours. Well, when it came time for him to buy a home for him and his family, rather than driving to look at 20, 25, 30 homes, at which point he's losing money because those are not billable hours that he could be spending in court or working for his clients. Instead, you'll just now look at 20 to 25 homes you're interested in online. and then only drive and spend the time to look at, the 3, 4, 5, 6 that you're actually serious about. So that not only saves people a lot of personal time, it actually grows the economy, because every hour that lawyer can spend actually working rather than, looking at home or having to go to a signing is money that adds to our economy and grows our GDP. So it's not only good for the industry, these gains in productivity are good for the overall economy as well, because it benefits not just our industry, but the overall macro economy. And so that is a win-win-win-win thing. And if said that such good things would result from the pandemic back when it hit us really hard in March, no one would have guessed it. But these times are more unexpected and uncertain than you might think. Lastly, I get asked this one all the time. So does the pandemic and the social unrest, it doesn't mean the death of cities? Are we all going to be, working from home permanently in our safe enclave in the suburbs and be socially distanced from all our neighbors? Well, history would not support that. In general, I think that the death of cities has historically been greatly exaggerated. We have an old saying in urban economics: cities don't die of natural causes, nor are they murder. They commit suicide. All right, what do I mean by that? Well, if you consider natural causes, there's been urban pandemics throughout history. They've been around for thousands of years. Rome, Athens, the Mediterranean, Alexandria, plenty of cities have experienced pandemics. I could walk you through all that history, but instead I'm going to focus on one that's very close to home, and that, of course, is Philadelphia. We look at the next slide. As most of you may know, the Spanish influenza of 1920, 100 years ago, hit Philadelphia the hardest of any large U.S. city. There were 12,000 deaths in Philadelphia from that pandemic. Remember, to keep that in context, we're up to about 2,500 deaths in Philadelphia right now. It's only about 1/4 of currently we're experiencing only 1/4 the fatality rate that Philadelphia experienced 100 years ago. And by the way, we were a smaller city then too, in terms of population. So the death rate in Philadelphia 100 years ago from the pandemic was not only absolutely higher, it was also relatively higher. You can see some pictures from that period right there. I like the woman on the lower right-hand corner. She's with her family on the SEPTA platform. She's got a sign around her neck saying, "Wear a mask or go to jail." So I think that's the original neighborhood Karen right there. You thought, she's something new. That annoying busybody has been around for 100 years. All right, so next slide, we'll see the mortality rate for Philadelphia. We were basically the New York City of the last pandemic. This is a chart from 1925 showing cumulative death rates over time over the 6 weeks in which the pandemic was most intense. And you can see Philadelphia was at the top of the chart, all right? So the last pandemic hit Philadelphia the hardest of any large U.S. city. It hit it much harder than the current pandemic did. So what happened to Philadelphia next? Well, you know what happened. Philadelphia recovered and it grew. By the way, the 1920s was the biggest decade for home building in Philadelphia's history. We built more homes during the 1920s than we in any decade before that, or even ever since, including the current one. All right, so we got past it. It sucks, but we got past it. All right, now that's natural causes. So they don't kill cities. What about murdering cities? What about that? I'm talking about war, right? I mean, that would constitute trying to kill a city. Plenty of historical examples of wars that have tried to destroy cities. Sherman burned Atlanta in 1864. They came back. London and Dresden were bombed terribly in World War II. They came back. What's the best example I can think of war trying to murder a city? Well, the nuclear bombings of Hiroshima and Nagasaki in World War II. Those are pictures of those two cities in just the days after they were bombed. Here's Hiroshima and Nagasaki today. All right, they were almost murdered. They bounced back. All right, they recovered and they're with us today and doing well. The bottom line: as long as the city maintains its location value, and by that I mean people and businesses are willing to pay to be there, they can rebound from almost any challenges. So pandemics have failed to kill cities. Wars failed to kill cities. What will kill a city is social unrest and failure in public services. That's the thing I worry about. So plenty of reasons to remain optimistic, not only on cities, not only on the housing market, but also on Philadelphia and Philadelphia's housing market. So with that, I say thank you for your time. And if you have any questions, I'll do my best to answer them.
Thank you very much, Kevin. It's been a wealth of information. So far, we've got one question from Julie. Is the city being saturated with new construction, too many units, and not enough people?
No. In general, our rate of new construction is roughly paced the net gain in new residents over time. In fact, I didn't say this when I showed you the one chart showing building permits in Philadelphia, but there was a black line on the chart, and that was the population of Center City over time. And if you notice that the population of Center City tracks the number of new units being added very, very closely. So, in the short term, it's a cyclical industry. We all know that. So in the short term, you might add, a few too many units, within which takes some time to be absorbed. So rents will cool off, vacancies will rise a bit. but that's just a normal market fluctuation. It lasts a year, maybe two, and then you get restored to your long run path of equilibrium after that.
Right. So one question that we get a lot, and we have our typical response, but I'm interested in how you would respond to the same question. A lot of people, we're on Rittenhouse Square. It's oceanfront property in Philadelphia. It's the best of the best. People always are worried about a recession. They're worried about, paying market value for their property now in the property value dropping. When somebody asks us that question at the Laurel, how would you respond?
Rittenhouse Square property is about as bulletproof as it gets when it comes to recession in terms of real estate. Again, you can experience some softening. I mean, even my Center City Condo Price Index experienced some softening during the last recession. But, the point of that index was to show you that it not only fell by less than not only the rest of the city, but also other product types in the city, including single-family homes in Center City. It also has recovered significantly and at a faster rate since then. So, it's not, and I said it was bulletproof. What I mean by relatively speaking is bulletproof. It outperforms, every category and every other location in the city during hard times and offers a higher rate of return during good times. Like I said, I'm more concerned about what the city's response is, to public services, public order, things like that, than I am about just, general fluctuations in the overall macroeconomy as how it will affect Philadelphia real estate. Great,
thank you. So, I've seen your report before, and this is actually, I think, the most bullish that I've seen on the Philadelphia real estate market in a while. Do you think this is going to continue?
The most recent indicators are that since summer ended, we have seen some cooling, but that's a normal seasonal fluctuation. So I think, there was that bursting of demand that we experienced this past summer. So, I think we may have overextended ourselves a little bit on that. So I think we'll see, I wouldn't call it a downturn, but just, more of a reversion to the norm during the next 6 months than what we saw in the 6 months prior to that. But again, we all know it's a cyclical industry. Nothing just goes up and up in perpetuity. Real estate tends to oscillate around a long-term equilibrium going forward. It doesn't follow, a straight line. And that's just the nature of the beast. So I wouldn't overreact to, 3 to 6 months of, of cooling off. What's going to happen beyond that is much more within our hands than I think. I think we have much more control over our destiny here in Philadelphia, or any city does than it gives itself credit for. Of course, everyone's worried about, who's going to be occupying the White House and taking the oath of office in January. That's important. But, whether or not we can have safe streets, we can have clean streets, we can have clean water, we can have clean public spaces, that's going to affect the future value of real estate in Philadelphia much more so than any legislation Congress is going to pass or, whoever the next president is going to appoint as the Secretary of Housing and Urban Development.
Great. Eva?
So Kevin, we have been receiving some calls and inquiries from New York City residents. Do you have any data or any take on that shift?
Yeah, I showed you that slide showing $1 million home sales, hitting an all-time spike. Part of that is driven by expatriates from New York. So they're doing, they're basically telecommuting to work at their job in New York, but they're making a New York income, but living in, paying Philadelphia prices and rents, right? So, $1 million home in New York is no big deal to the average Manhattanite. It's a big deal to us. So, they have no problem paying $1 million plus for a home. They have the wherewithal to do it. But if they can get a home on the main line with plenty of green space, also much the better. And they're still within a relatively reasonable commute to New York if they have to run up there, for a meeting or two, during the week. So I don't have any hard empirical data on that because it's just not, in the home sales data or condo sales data, it doesn't tell you where someone's moving from. But I present to the realtors all the time. And one of the reasons I like talking to them is because they're the ones that have access to the information because they're dealing with the actual buyers and sellers. And particularly in the suburbs, they said is where they're seeing it. And less so in the city, but in the suburbs in particular, that big spike in $1 million sales, I'd say probably a good 25 to 35% of it is New York metro area households, relocating here.
So Kevin, we have another question from one of our guests watching at home. Is there any development planned or going on in North Philadelphia area, specifically maybe the North Broad Station development?
Oh yeah, West Philadelphia. I showed you the chart showing the City house prices outperformed suburban ones over the course of the past year. Within Philadelphia, North and West Philadelphia outperformed the rest of Philadelphia over the course of the past year, even Center City. And a lot of that is driven by the institutional capital, by the major anchor employers in those neighborhoods. I'm speaking particularly the universities. So Temple, Penn, Drexel have invested very heavily in the neighborhoods surrounding them. That's had a spillover effect and catalyzing effect on sort of the next, few blocks of development, which has attracted both private and public capital, like you mentioned, around the North Broad Station. So we've seen significant home transactions and price appreciation in North Philadelphia and West Philadelphia over the course of the past year. But again, remember, that's also a mathematical result in addition to being an economic result. If you're starting from a very low level of prices, a $10,000 increase in prices will result in a bigger percentage increase to a low-priced home than it would from a high-priced home, right? If I increase the price of Center City condos by $10,000, that's barely a dent in the price appreciation. But for a typical North Philly home that's priced at $60,000, if I increase its value by $10,000, that's a big percent increase, right? So that's, again, a mathematical result and not just an economic result as well. But yes, we are seeing a significant investment in those communities.
Got it. So question that I just received via email. I've been sitting on the sidelines waiting for the market to get a little bit more stable. Am I making the right decision, or should I just pull the trigger?
Well, by stable, I mean it's doing quite well right now. So I think by stable meaning that they're waiting for things to cool off, not that they're waiting for things to recover. It depends. I mean, what's your horizon here? I mean, are you planning on buying a place and living in it for 10 years, 10 plus years? That's a different. My answer would be different than if you're planning on buying a place because you want to flip it in 6 months and make a quick dollar. During the last housing recession and the last recession in general, as you know, it was driven by the bursting of the housing bubble. And I think one of the things that caused it is that we forgot that first and foremost, a home is primarily a place, to live and work. And second, it's a asset that grows your wealth. That got turned upside down, during the housing bubble. People started to view homes as primarily a wealth generator first and a place to, live and work or spend time with secondarily. So they began overpaying for things and became, excessively optimistic about things. So I would advise you to ask yourself, what is your horizon here on this? If you're looking to just flip a unit like many people were doing during the last, cycle, I'm not going to say do it or don't do it. I'm saying that it's more difficult to predict how they will turn out for you than if you plan on buying a place for 10 years and holding. Because if you're planning on buying a place on Rittenhouse Square in Center City for 10 years, there's no point in waiting any time. It's going to perform well over 10 years. Could your return on it maybe be a few percentage points one way or the other if you waited 6 months or a year? It could, but over the long term, Center City real estate has beaten the stock market. It's certainly beaten the bond market. It's beaten the rest of the city elsewhere. So, I would think you want to consider in terms of where you're parking your investment dollars, not just what the rate of return could be in terms of the timing of your real estate investment, but how that investment is going to do relative to other ones. And there, the bottom line in history is pretty clear. And that is that Center City is always a winner, no matter when you buy. As long as your horizon is sufficient, not just 6 months, right?
Great. We have another question from Stephanie. She apologized for jumping on late. She says, I'm curious how working remotely might impact the future of cities and housing. Sure.
Well, I actually covered that in my presentation. Maybe you didn't see it. Like I said, as long as as long as the location value of cities is there, the demand to be in a city is there, then cities will survive. I remember, I'm actually old enough to remember when the internet debuted back in the 90s. Economists were saying, is this going to be the end of cities? Because we could also work virtually from home. What happened to cities from the mid-90s through today? They had some of the best decades in history, okay? So cities have proven enormously resilient to challenges, both whether it be pandemics, whether it be technology, whether it be war. Like I said, the thing that kills cities is when they choose to commit suicide. They don't provide sufficient public services. There's not sufficient public order, things like that. Those are the things that actually kill cities, not technology, not disease, not war.
That's great. Eva, any other questions?
No, I think that's all. We're probably going to get later because we usually get some questions. So
Kevin, online, we've got a handful of people just thanking you for such an amazing presentation, and people asking for a copy of the presentation, which with your permission, we'd love to supply them.
As long as you PDF it first, that's fine.
Yeah, absolutely. All right, Kevin. Again, thank you for everything. Thank you for your time. We hope you and your family stay safe, and we look forward to seeing you next time.
and we thank everybody who joined us today for the presentation.
Thank you, Brian. Thanks for having me, and my best of luck to you and everyone else who's joined us today.